Ever heard someone say quantitative easing or liquidity crunch and felt totally lost? Don't worry, you're not alone. Finance is full of complicated terms that sound intimidating, but today I'm breaking them all down in the simplest way possible. Whether it's GDP, derivatives, or even dark pools, by the end of this video, you'll understand them all with real-life examples. Think of this as your personal finance dictionary. Bookmark this video because I'll be referencing it in future videos whenever we discuss these topics. Ready to finally make sense of financial jargon? Let's dive in. Before we get into the more complicated stuff, let's start with the absolute basics. These are the building blocks of finance. Understand these, and everything else will start making sense. 1. Assets. What you own. An asset is anything that has value and can be owned, used, or controlled to generate future benefits. Think of assets as the things that put money in your pocket, either now or in the future. Assets are mainly divided into two categories: tangible assets, physical things you can touch, real estate, land, houses, buildings, cash, and physical gold, cars, and machinery. Intangible assets, things that hold value but aren't physical. Stocks, bonds, mutual funds, patents, copyrights, trademarks, Bitcoin, and other cryptocurrencies. Example: imagine you own a house worth $300,000. That house is an asset because it has value, and if needed, you can sell it for money. Even something like your phone can be an asset, if you can sell it later for some value. 2. Liabilities. What you owe. A liability is the opposite of an asset. It's something you owe to someone else, a financial obligation that takes money out of your pocket. Types of liabilities. Short-term liabilities, due within a year. Credit card debt, utility bills, short-term business loans. Long-term liabilities, takes years to pay off. Mortgages, home loans, student loans, car loans. Example: if you take out a $50,000 loan to buy a car, that loan is a liability. Even though you now own a car, you owe $50,000 to the bank. In short, assets increase your wealth while liabilities reduce it. The goal? Own more assets and fewer liabilities. 3. Equity. Your true ownership. Equity is the value of what you truly own after subtracting any debts. In simple terms, it's your real share of something. Formula: equity equals assets minus liabilities. Example 1. Home ownership. Let's say you buy a house for $300,000, but you took out a mortgage loan of $200,000. Your equity in the house is the part you actually own. $300,000 house minus $200,000 loan equals $100,000 equity. Example 2. Business equity. If you own a business worth $500,000 but owe $200,000 in loans, your business equity is $300,000. Equity is also used in the stock market. If you own 10% of a company's stock, you have 10% equity in that company. 4. Liquidity. How quickly you can get cash. Liquidity measures how fast you can turn an asset into cash without losing much value. Some things are easy to sell, while others take time. High liquidity assets, fast to sell. Cash, you can spend it immediately. Stocks can be sold within seconds or minutes. Gold, easy to trade. Low liquidity assets, hard to sell. Real estate, takes months to sell a house. Art, finding a buyer for a rare painting takes time. Collectibles, old comic books, rare coins, etc. Example: if you need money urgently, selling your car might take days, but withdrawing cash from your bank takes seconds. That's why cash is the most liquid asset. The more liquid your assets, the easier it is to cover sudden expenses without financial stress. 5. ROI, return on investment, measuring profit. Return on investment, or ROI, measures how much money you make from an investment compared to what you originally put in. Formula for ROI: ROI equals final value minus initial investment, divided by initial investment times 100. Example 1. Stocks. You buy shares in a company for $1,000. A year later, those shares are worth $1,500. Your ROI is ROI equals 1,500 minus 1,000 divided by 1,000 times 100 equals 50%. Example 2. Buying and selling a house. If you buy a house for $200,000 and sell it 5 years later for $250,000, your ROI is ROI equals the difference between $250,000 and $200,000 divided by $200,000 times 100 equals 25%. This means you made a 25% profit on your original investment. Why ROI matters: helps compare different investments, shows whether an investment is worth it. Higher ROI means higher profit. Let's quickly recap what we learned. Assets: things you own, house, stocks, gold. Liabilities: money you owe. Loans: credit card debt. Equity: your true ownership after subtracting debt. Liquidity: how quickly you can access cash. ROI: how much profit you make on investments. Now that we've covered the basics, it's time to level up. These are the terms that news anchors, investors, and central banks throw around, but today we're breaking them down into bite-sized, easy-to-understand concepts. 1. Quantitative easing, QE. Printing money without printing paper. Let's say an economy is struggling, people aren't spending, businesses are failing, and unemployment is rising. The central bank, like the Federal Reserve in the US, has a special trick up its sleeve: quantitative easing, or QE. How QE works. The central bank creates new money, not physical cash, just digital numbers in the system. It uses this money to buy government bonds and other assets from banks. Banks now have more cash, so they can give out more loans to businesses and individuals. With more money in the economy, people and businesses spend more, boosting economic growth. Example: the 2008 financial crisis. After the 2008 crash, the U.S. government used QE by injecting trillions of dollars into the economy to prevent a total collapse. Potential risks of QE: inflation. If too much money enters the economy, prices rise. Think of Venezuela or Zimbabwe. Asset bubbles. Stock markets can skyrocket because of artificial money flow, leading to sudden crashes. It's like giving a patient medicine. Too little, and it won't work. Too much, and you get dangerous side effects. 2. Stagflation, the worst of both worlds. Stagflation is what happens when inflation, rising prices, and economic stagnation, low growth, happen at the same time. It's a nightmare for governments because normal solutions don't work. Why is it a problem? If inflation is high, the central bank raises interest rates to cool it down. If the economy is slow, the central bank lowers rates to boost spending. But in stagflation, both problems exist together, and fixing one makes the other worse. Example: the 1970s oil crisis. In the 1970s, oil prices soared, making everything more expensive. At the same time, economic growth was slow, leading to years of stagflation. When you hear analysts worrying about stagflation today, they're afraid history will repeat itself. 3. Derivatives, bets on the future. A derivative is a financial contract that gets its value from something else, like stocks, bonds, or even commodities like oil. Two main types of derivatives: futures, a contract to buy or sell something at a fixed price in the future. Example: airlines use futures to buy fuel in advance so they don't get hit by sudden price hikes. Options, a contract that gives the right, but not the obligation, to buy or sell an asset. Example: If you think Apple's stock will rise, you can buy an option to purchase it later at today's price. If it does rise, you profit. How are they used? Investors use derivatives to hedge risks, protect against losses. Traders use them to speculate, make bets on market movements. Derivatives sound complex, but at their core, they're just tools for managing risk or making big bets. 4. Yield curve, the economy's crystal ball. The yield curve shows the relationship between interest rates on short-term and long-term government bonds. It's like a weather forecast for the economy. 3 types of yield curves. Normal curve, upward slope, economy is growing. Flat curve, straight line, uncertainty ahead. Inverted curve, downward slope, recession warning. Why does an inverted yield curve matter? Historically, an inverted yield curve has predicted almost every recession in modern history, including 2008. 5. Cryptocurrency terms, DeFi, staking, cold wallets. Crypto has its own language, and if you don't know these terms, you'll feel lost. Let's break them down. 1. DeFi, decentralized finance. DeFi is like banking without banks. Instead of a central authority, people use blockchain technology to lend, borrow, and trade assets directly with each other. 2. Staking. Staking is like earning interest on your crypto. You lock up your coins to help keep the blockchain running, and in return, you get rewards. Example: if you stake 10 Ethereum, you might earn 5% per year in rewards, just like putting money in a savings account. 3. Cold wallets versus hot wallets. Hot wallet, connected to the internet, faster but riskier. Cold wallet, stored offline, safer from hackers. Think of it like cash in your pocket, hot wallet, versus cash locked in a safe, cold wallet. Let's do a quick recap. Quantitative easing, QE. Central banks creating money to boost the economy. Stagflation. When inflation and slow growth happen at the same time. Derivatives. Contracts based on future prices used for hedging or speculation. Yield curve, a graph that predicts economic health, inverted equals recession warning. Cryptocurrency terms, DeFi, no banks, staking, earn rewards, cold wallets, safe storage. Now that you know the advanced terms, it's time to zoom out and look at the bigger picture. Economists and investors don't make guesses. They use key indicators to understand how healthy an economy is. Today, I'll explain 4 of the most important ones in the simplest way possible. 1. GDP, Gross Domestic Product. The economy's report card GDP, or Gross Domestic Product, is the total value of everything a country produces in a year. Think of it as a country's annual income. How GDP works. If a country makes cars, phones, software, food, and clothes, the total value of all these goods and services is added up. The higher the GDP, the stronger the economy. If GDP shrinks, the economy is struggling, possibly in a recession. Example: US versus India versus Japan, GDP comparison. US GDP, $25 trillion, India, GDP, $3.7 trillion, Japan, GDP, $4.3 trillion. Types of GDP: nominal GDP, the actual number; real GDP, adjusted for inflation to show real growth. 2. CPI, Consumer Price Index, why your groceries cost more. Have you ever noticed that food, rent, and fuel get more expensive every year? The Consumer Price Index, CPI, measures how much the prices of everyday goods are rising. How CPI works. Economists track a basket of common goods, like milk, bread, rent, electricity, and gasoline. They check how much the prices of these items change over time. If the CPI goes up, it means the cost of living is rising, inflation. Why is CPI important? High CPI equals inflation problem, prices are rising too fast. Low CPI equals stable economy, prices are under control. Negative CPI equals deflation, prices are falling, which can hurt businesses. Example: Let's say last year a cup of coffee cost $2, but now it's $2.50. That's a 25% increase in price. If this happens to everything in your daily life, your salary might not keep up, making everything feel more expensive. 3. Unemployment rate. Why 3% is good, but 4% freaks out the Fed. The unemployment rate tells us how many people in a country want to work but can't find jobs. How it's measured. If 100 million people can work and 4 million are unemployed, the unemployment rate is 4 million divided by 100 million times 100 equals 4%. Why it matters. If unemployment is too high, above 6 to 7%, it means businesses aren't hiring and the economy is weak. If unemployment is too low, below 3%, it means businesses can't find enough workers, which can drive wages and inflation up. The sweet spot is between 3 to 5%. Example, during the COVID-19 pandemic, unemployment in the U.S. skyrocketed to nearly 15%, causing an economic crisis. But today, it's back to around 3.5%, which is considered healthy. 4. Interest rates. The economy's gas pedal and brake. Interest rates are the price of borrowing money. The higher the interest rate, the more expensive it is to take out loans. The lower the rate, the cheaper it is to borrow. How interest rates work. When the economy is struggling, central banks lower interest rates to encourage people to borrow and spend money. When inflation is rising too fast, central banks raise interest rates to slow down spending. Example, how it affects you. Let's say you want to buy a house and take a loan. If interest rates are low, 3%, you pay less in monthly payments. If interest rates are high, 7%, you pay way more in monthly payments. Interest rates and the stock market. When the Federal Reserve raises rates, it becomes harder for businesses to borrow money, which slows down their growth. That's why stock markets often drop when interest rates rise. Let's recap these 4 key economic indicators. GDP measures total economic output. High GDP equals strong economy. CPI measures inflation. Higher CPI equals higher cost of living. Unemployment rate tells us how many people can't find jobs. 3 to 5% is ideal. Interest rates control borrowing costs. Low rates boost spending. High rates slow inflation. Now that we've covered the big picture economic indicators, let's zoom into the corporate world. Understanding these terms will help you analyze businesses, make smarter investments, and see how companies are valued in the stock market. 1. Market capitalization, market cap. How big is a company? Market capitalization, or market cap, is the total value of a company's shares. It's one of the easiest ways to compare companies of different sizes. How market cap is calculated. The formula is simple. Market cap equals total shares times share price. For example, if Apple has 16 billion shares and each share costs $180, then 16 billion times 180 equals 2.88 trillion. Apple's market cap is $2.88 trillion. If Bitcoin has a market cap of $1 trillion, it means Bitcoins combined are worth $1 trillion. Why it matters? Large cap, over $200 billion. Giant, stable companies. Mid cap, $2 billion to $200 billion. Growing companies with more risk. Small cap, under $2 billion. Startups and high-risk companies. 2. EBITDA, a company's true profitability. Ever wondered how profitable a company really is? That's where EBITDA comes in. It stands for earnings before interest, taxes, depreciation, and amortization. A fancy way of saying how much money a company makes before paying extra costs. Why EBITDA matters? It shows a company's ability to generate profits before financial complications. Investors use EBITDA to compare different companies fairly. Example, Tesla versus Ford. Let's say Tesla's revenue equals $100 billion. Ford's revenue equals $100 billion. but after removing interest, taxes, and other expenses, Tesla EBITDA equals $25 billion, Ford EBITDA equals $10 billion. Even though both companies make the same revenue, Tesla is more profitable because of its higher EBITDA. 3. P/E ratio. Is a stock overpriced or cheap? If you've ever heard someone say, "This stock is overpriced," or "This stock is undervalued," they're probably looking at the P/E ratio. It stands for price-to-earnings ratio, and it helps investors see if a stock is too expensive or a good deal. How P/E ratio works? The formula is P/E ratio equals stock price divided by earnings per share. Example, Tesla versus Exxon. Tesla stock price equals $1,000. Tesla earnings per share equals 14 P/E ratio equals 1,000 divided by 14 equals 70. Exxon stock price equals $100. Exxon earnings per share equals 10. P/E ratio equals 100 divided by 10 equals 10. Tesla's P/E ratio of 70 means investors are paying 70 times its earnings, which is very expensive compared to Exxon's P/E ratio of 10. What's a good P/E ratio? High P/E greater than 30. The stock is expensive, but investors expect high growth. Low P/E less than 15. The stock is cheap, but growth might be slow. 4. Hedge funds, the secretive billionaire investors. Hedge funds are private investment firms that manage billions of dollars. Unlike normal investors, they use high-risk strategies to make profits, even in a market crash. How hedge funds work? They borrow huge amounts of money to amplify their trades. They use strategies like short selling, betting against stocks. Many hedge funds influence stock prices because of their size. Example, GameStop short squeeze. Hedge funds bet against GameStop in 2021, expecting its stock to fall. But Reddit traders bought GameStop in huge numbers, causing the stock price to skyrocket. Hedge funds lost billions as the stock price went up instead of down. Let's recap what we've learned about how businesses and stocks work. Market cap measures a company's total value. EBITDA, a company's true profitability before extra costs. P/E ratio shows if a stock is overpriced or undervalued. Hedge funds, billion-dollar investors who use high-risk strategies. You've made it to the final section, where we uncover the lesser-known but incredibly powerful financial concepts. These terms might not come up in everyday conversations, but they drive major market movements, influence government policies, and impact global economies. Let's break them down in the simplest way possible. 1. Dark pools, the stock market's hidden transactions. Imagine you're playing poker, but half the players are making secret bets under the table. That's basically what dark pools are in the stock market. What are dark pools? Dark pools are private exchanges where big institutions like hedge funds and banks trade stocks in secret, away from the public stock market. Why do they exist? If a hedge fund wants to buy 1 million Apple shares, doing it publicly would spike the price before they finish buying. Instead, they use dark pools to buy secretly, avoiding major price swings. Example, why it's controversial. In 2014, Barclays was fined for misleading investors about its dark pool. Some believe dark pools manipulate stock prices and give an unfair advantage to Wall Street. Second, secular versus cyclical trends. Long-term versus short-term markets. Have you ever noticed that some industries seem to grow forever while others go through boom and bust cycles? That's the difference between secular and cyclical trends. Secular trends, long-term growth. These industries keep growing regardless of the economy. Technology, AI, cloud computing, software. Healthcare, aging populations increase demand. Example, Apple stock has been rising for decades because technology keeps evolving. Cyclical trends, boom and bust industries. These industries rise and fall with economic cycles. Oil and gas, demand surges, then crashes. Real estate, booms during low interest rates, crashes in recessions. Example: oil prices crashed in 2020 when COVID reduced travel, but surged in 2022 with global conflicts. 3. Velocity of money. How $1 becomes $5. Have you ever heard that the same dollar changes hands multiple times? That's called the velocity of money, a key factor in how fast an economy grows. What is the velocity of money? It measures how often money is spent within the economy. High velocity, money moves fast, boosting growth. Low velocity, money sits idle, slowing down the economy. Example: how $1 becomes $5. You spend $1 at a coffee shop. The coffee shop owner pays their supplier. The supplier buys groceries. The grocery store pays an employee. That employee buys a movie ticket. Your original $1 has now created $5 of economic activity. 4. Black Swan events, the unpredictable disasters. A black swan event is a rare, unpredictable event that shocks the entire world and causes financial chaos. Examples of black swan events: 2008 financial crisis. Banks collapsed unexpectedly. COVID-19 pandemic crashed global markets overnight. September 11th attacks triggered massive stock sell-offs. Why are black swan events so dangerous? They can't be predicted. No one saw COVID coming in 2019. They have a massive impact, billions lost in the stock market. They changed the world forever. 2008 crisis led to stricter banking rules. Let's quickly recap the secret financial concepts you just learned. Dark pools, secret stock market trades by big players, secular versus cyclical trends, long-term versus boom and bust industries. Velocity of money, how spending $1 creates more economic activity. Black swan events, rare, unpredictable financial disasters. Wow, we've covered a lot. From basic financial terms to secretive Wall Street strategies, you now have a solid understanding of the financial world. The world of finance can feel overwhelming, but now you have a go-to guide for all the key terms. Whenever you hear a complicated financial term in the news, in a YouTube video, or in a conversation, just come back to this video. It's your personal finance dictionary. Now that you understand these terms, you're one step ahead of most people, but the real power comes when you apply this knowledge. So here's what to do next. Hit that like button. If this helped you, let me know. Share this video. Help others understand finance in a simple way. Subscribe, because I'll be diving deeper into finance, investments, and economic trends in future videos. Comment below. What finance term confused you before this video? Let's discuss.